Hey everyone, welcome back to Yuri's Box. In this video I'll be talking about TLT, the weekly close, and the week ahead. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, it'll kind of be a mashup. I won't be online during the weekend, so you're getting everything basically in one video. So the week that just passed was really quite a snooze fest, if you ask me. Again, we didn't really see anything too dramatic. Again, we tried to pop up above $88, but again, everybody was kind of trying to wait and really deal with the FOMC and Powell's press conference. And again, we talked about that in a video I made on Wednesday. And again, it didn't give us anything new, really, okay? We already know that Powell's going to be late because that is what the Fed does. And we know he's going to be late because this cycle, as I argued before, is less similar to the 2010s and more similar to prior cycles, all right? And I think that argument is valid, and it is particularly relevant in these days right here because, again, I sense a growing frustration with TLT, and it is easy, quite easy to be frustrated with an asset that has seen nothing but declines for, well, really ever since 2020, about 5 years now. And at best, we can call this a bottoming phase. At worst, we can call this a continuation phase, all right? This could just be a huge bear flag playing out. But, given the context of history and everything we looked at, for example, TLT likes to put in double bottoms. This was one of the first things I talked about in my when I started making videos. Usually TLT puts in double bottoms. Again, it's usually either a sweep of the previous low like we saw in 2007 or a slightly higher low like we saw in the early 2010s. Currently, TLT has yet to put in a sweep of the previous low. Now, this is something we've talked about. I remember us being right here, the time when I was saying that, ignore all the technical analysis, ignore the squiggles on the lines, and sure enough, we actually retested the trend line we broke out of. But one thing I always, cautioned everybody on is that there is still the possibility that we actually retest the previous low and we actually sweep it. All right. Just to give a parallel to, the 06-08 cycle, maybe I was wrong when saying, that we were right here in August 07. Perhaps we're still on the uptrend in this phase right here. When, we put the first significant top, then the W pattern, and then a sweep of the previous top, which would, again, be equivalent to basically a sweeping the $82 region here, and then move lower. Only then we move lower. And I think that, again, if you look at, today's price action, it kind of looks, fitting, honestly. Could this still be the uptrend? And we're kind of building up to the sweep of the previous low where we get perhaps we get a bad inflation read, worse than expected. And all right, there are already certain stagflationary fears already in the market, and a bad inflationary read next week could potentially exacerbate those fears, and maybe we see something dramatic, and we see actually sweep of the previous high, and we actually fulfill the 06-08 move. So we keep going up, and then we actually get a sweep. All right, we get something around, I don't know, something like somewhere between 5.2 and 5.4 on the 30-year bond, which would actually put us above, below the $82 mark, somewhere around here, honestly, around $80, $79, something like that. Now, I'm not banking on it. Like I still don't know. I'm open really to both outcomes potentially. I'm open to this being the early 2010s. All right, like we have a low and then a higher low, which could very well be. But I still leave some room open for some potential pain ahead. And why do I say that? Because again, I've already made a video on stagflation in the US. And my verdict is that stagflation isn't the end game. All right? I've made that clear many, many times. I still am in the camp that eventually, all right, it'll be a process. We won't get there through spikes. We won't get there through everything turning by a smoking gun. Say, from this month to the next, we get minus 500K on non-farm payrolls. I think we'll slowly flirt with it and eventually we get there, but it'll be a process. Between here and that, there is an air pocket. And what is that air pocket? And I think that the best way to describe that air pocket is, again, look back at history. And again, we'll be looking at the 06-08 cycle. Now, just before we do that, another way of visualizing the fact that we are indeed in a slowdown is just by looking at the number of unemployed people for 26 weeks and over. Okay, that's basically half a year. To put things into perspective, while we are, well, not necessarily at the lows right here, and when, again, not at the highs, say at 4 million, we are, however, not too far away from the 2003 peak. Okay, so we're definitely building up some momentum again, and I think that the best word to describe this is a slowdown. It's not a depression, it's not a recession. We haven't been in a recession. We haven't been in a depression. We are in a slowdown. And I think that this is another way of visualizing it. But to better describe where we are right now, I think, again, 2008 serves us well. And it also serves us well in kind of digesting some of the price action that we've been seeing in the 30-year bond and bonds in general. Because I get a sense that a lot of people are asking, are bonds broken? All right, is the only thing that's going to work with bonds is shorting them? All right, because it is definitely the consensus trade, and it is one of the things that makes me, bullish for the rest of the year in 2026 on bonds. Is also the fact that everyone is looking at shorting bonds. Looking at 06-08. Particularly January of 08 till June of 08. And I think that this particular time frame right here is quite interesting because while we don't have our own Bear Stearns, and I'm not banking on us having a Bear Stearns moment, we did have some similar things, similar circumstances. From January of 08 till June of 08, we had inflation go from 4.3 to 5.6. At the same time, non-farm payrolls went from 1K, a strong and a powerful 1K on non-farm payrolls, to basically minus 200K. All right, June is minus 150. July was 200K. So think about for a moment. We had Bear Stearns, a traumatic event, where I'm guessing everyone is saying no, liquidity is strong, we're doing great, and then that all comes crashing down, which was negative for the economy. At the same time, we had declining non-farm payrolls, while we're at it, I think it would be good to see initial jobless claims. Right here, we weren't seeing anything too dramatic until, well, yeah, really, we were still pretty much in line with initial jobless claims, although they were still moving up. So we were in a position where inflation was going up and non-farm payrolls were negative. That is the kind of the definition of really a stagflation environment. And sure enough, yields from January of 2008 to June of 2008 went up. And they didn't go up by a couple of basis points. They went up by 60 basis points. Effectively, they retraced basically all of this move right here. And yields on the 30-year bond actually went back to where they were, well, basically in March of 2006 and, May of 2007. All right? Like, basically half of this move was undone. And this played out, again, in 6 months. It wasn't just, a spike happening. It was a process. And why do I bring this moment in time up right now? Because what do we have right now? Do we have negative payrolls? No. Payrolls have, this is clearly, the trend is, down onto the, and down and to the right, not up and to the right. We're in a slowdown. Okay, we're definitely not in a recession. We're in a slowdown. So we have growth coming down, all right? We don't have all of those strong tailwinds to growth that we had back in 2023 and, in 2022. And at the same time, we have inflation, what I've been calling inflation PTSD, possibly heightened by, the tariff drama. We don't have it really in the numbers, but we do have the potential for a stagflationary environment. Now, I've discounted this in my previous video because, again, oil isn't really cooperating with that thesis. And again, you have a lot of supply and demand things playing into the price of oil. So again, oil could easily spike up back to, the 70s, for example. However, given all of the front running and all the possible effects that tariffs could have, there is certainly the possibility that tariffs end up being inflationary, have a secondary bout of inflation. Maybe we end up at 4%. I don't know. Regardless, that is how something like bonds are behaving for the time being. This price action right here is, in my opinion, discounting a stagflationary outcome. Or at the very least, and not an outcome, it is just describing current conditions. Do we have a collapsing labor market? No. There's the possibility that we'll see weakness, and I've been a proponent of that idea even before the tariff drama. I keep saying, and I'll reiterate it now, keep an eye on summer, because again, I thought summer would be an interesting time before the tariff drama. I believe it to be even more interesting after the tariff drama. But as of now, what does the market have and what can it react to? It has inflation PTSD and non-farm payrolls really being okay. Now, you might say, but what about all the PMIs you've been reading? All of the beige book you read, you made a 55-minute video on the beige book where you read that, a lot of businesses are worried and the outlook isn't looking too good. And to that I say, look at the price action. Bonds especially have been far more sensitive to the inflation side of the story than the growth side of the story. As of now, what I see is, again, an asset class that is discounting a stagflationary environment. And to say that, I mean, really, just look at the PMIs when they were released. Yes, we may have had some, upward pressure on TLT, but eventually, all it took us, if you recall, on when was that? When I think this week we got the ISM. We got one good ISM report on services that was actually a beat, and it was actually one of the first good reports we got. And bonds kind of, reacted to that, right? They reacted to that. As of now, the market seems to be more concerned with inflation. Now, I'll say it again. This is a phase, and this is part of the the process that will take us to the growth concern. And that is when the 30-year bond shines. Because this leads me to, a very important point, in my opinion. There's this idea that bonds protect you against rising recession probabilities. But I come back to the 06-08 cycle. What was the collapse of Bear Stearns, if not rising recession probabilities? What was the collapse of Lehman Brothers, if not rising recession probabilities? We had a lot of reasons to be suspicious about growth throughout this cycle, all right? Yet, bonds really didn't have much of a move. Now, granted, again, I don't want to be too severe here, but yes, we did have a 60 basis point move. Okay. Yes, absolutely. But I think that what everybody thinks about when they think about the 30-year bond is this move right here. And that is really the reason why everybody buys TLT. This is the kind of move you want. Because again, you might say, yeah, 40%, but you're making 40% at the same time when stocks are losing 40%. So this is a big deal, all right? And this is the kind of move everybody wants from TLT. But here's the thing. This move didn't come right here, nor did it come here. It didn't come with rising recession probabilities. It came with recession certainty, when recession was a done deal. It was done. The only thing we could do was try to figure out how we could get over it and get out of it. So again, try not to get sucked into, and again, I get it. It sounds appealing. It sounds feasible. It sounds kind of correct. And yes, of course, rising recession probabilities, you could say that this move right here is rising recession probabilities. I would argue, again, as I've argued before, this right here is rising recession probabilities, and bonds offered you no protection. Bonds, while in a downtrend right here, they still found a way of going up. All right, now there could have been mechanical reasons for that. There could have been liquidations, whatever. Honing into this period of time right here, rising recession probabilities did nothing for the 30-year bond. You want to know what performed very, very well in this time frame right here? Gold. Because gold, the beauty of gold is that it is a hedge against uncertainty. perhaps rising recession probabilities. But it's kind of the flip side of the 30-year bond. When recession is a certainty, that's when it does nothing for you. All right, it is. All right, see ya, I did my thing. I went up. It was good while it lasted. I'll see you in a couple of months' time. That's basically what gold does. It goes up in times of uncertainty, and uncertainty can be a stagflationary environment, like potentially we're kind of living through right now, although I don't believe that it is the end game. But do we have slowing growth? Yeah. Do we have at least a fear of a second bout of inflation? Yeah. You put two things together, it's a sad version of stagflation, but you can make the argument for it. So again, gold is what you want in the lead up. It's what you want in the lead up, but it's not what you want in the certainty phase. When you know that you're going to have a recession, you don't want gold. That's when you want the 30-year bond. But are we here? Are we there today? Do we have negative payrolls? No. Do we have initial jobless claims misbehaving and printing over 250K at the least? No. And on top of that, we have, okay growth. And on top of okay growth, we have inflation fears. It is hard to imagine TLT being well behaved in this kind of environment right here. Now, I personally, as I've said before, and I'll say it again, this will be a process. And if you haven't watched my previous video, I'll tell you again right now. One of the ways I could envision this process playing out is, again, now we're kind of building up. Then perhaps we get to the summer, as I've been hinting at ever since I started making videos, and perhaps we get into some of the weakness that we saw last year. All right, with the weak payrolls. I know for certain this wasn't 159K. This was still fairly weak. Now I have to put my detective hat on. Let's look at non-farm payrolls. I love doing this live. Here we are. I sure hope, yes, of course, here we are. I was just about to say, I sure hope they have the updated numbers. That would have all been for nothing. So during the summer, perhaps we get to the summer and we have something similar occur. Or again, might be a bit weak, but during the summer we get close to, between 0 and 75K, perhaps. And we stay in that kind of environment. And that's kind of phase 2. And the second part of phase 2 is perhaps we don't have this right here. The end of Q3 and Q4, we don't have all of those transitory events that made inflation look worse and growth look better. So really we don't have anything to fall back on. And so this growth scare potentially goes to something a little bit worse. Now, I'm not calling for a depression or anything. I hope we don't get a depression. But perhaps we get some kind of a resolution. And that's one way that we could get a hard landing. And at that point, TLT will start to behave the way everybody wants it to behave. Meaning, we could see a significant rally. Perhaps starting, I don't know when, all right? It might be next month with a bad report. But that's another thing. I do believe, and this is another symptom of the fact that we are in a slowdown. And I think that everybody's acknowledged that at this point, is that good news is good news and bad news is bad news. Meaning, if next week we get another cool inflation report, I wouldn't be surprised if the bond market actually doesn't look through it this time. Because if you recall, last month we had ice cold inflation, and bond market kind of looked through that. So that's on the inflation side. On non-farm payrolls, let's say we get a horrible read. Horrible is bad news. If we get a great read, that's good news. And assets will react accordingly. I think that we are definitely outside of the era, the era of bad news being good news and good news being bad news is over. And I think that Powell's press conference on Wednesday kind of marks the end of that era. So kind of to summarize, don't look for TLT to do things it hasn't done in the past. And be specific with, with what you look at. Because to say that bonds are a hedge against uncertainty and they're a hedge against rising recession probabilities, again, I think that this is one of the best examples I can give you. 2008, from January till June, we saw yields go up. And right smack in the middle, we had Bear Stearns, which was one of the two biggest failures that we had. Well, one of the biggest failures that we had in 08. We had definitely had AIG, Lehman Brothers, and God knows how many more. But it was definitely one of the turning points for the cycle. And in the face of that, yields went up. And what was the collapse of Bear Stearns if not rising recession probabilities? All right. And that kind of environment, uncertainty reigns supreme. And when uncertainty reigns supreme, gold reigns supreme. Potentially like we're seeing today. So again, we are not in a position yet when we can get this kind of a rally. Far from it. I definitely think we are months away. Because again, as I've said many, many times, this will be a process. We won't get, the eureka moment. We might, but I'm not expecting it. I'm expecting it to be a continuation of the slowdown, which eventually will culminate into some kind of a landing, some kind of a resolution. Be it soft, hard, be it shallow and long, short and hard. I have absolutely no idea. That will be something to assess in the future. So I just wanted to make this really clear, because otherwise it is very easy to be frustrated. Again, potentially right here, you could easily be DCAing instead of potentially throwing in the towel, for example. Now, again, I should have probably said this at the beginning, but this video could easily be irrelevant by the time it comes out, and by the time, markets reopen on Monday, and perhaps we're down at 70, and it's the end of the world. The bond market blew up. We could definitely be in that kind of environment. I hope we're not. For obvious reasons. But again, I still maintain my constructive outlook for bonds. Just maybe for the time being, we see some little bit more pain. Who knows? Who knows? Again, next week, and again, now this is part of what comes up next week. We do have an inflation print, all right, and we're expecting. We actually do have some forecasts right now. We have the core at 0.3. Month over month 0.3, and year over year to stay flat. Again, if we continue to see basically deflation, what we saw last month, that would be good news for bonds. And even if bonds decide to shrug it off, it would still be good news. All right, it would continue to help drive away that stagflationary narrative that is really mainstream at this point. Let me see if I'm not forgetting anything. no, Monday, Tuesday, yes. And then on Thursday, we have PPI. Again, look at PPI for potentially what we might get in the PCE. Read later at the end of the month. I can't find it right here, but in any case, look for, again, the PPI and the certain, components that make up PCE, and the bond market will kind of extrapolate, possibly a hotter or cooler read of the PCE at the end of the month, like it has done before. We also get regional Fed surveys. Well, I'd be curious to see again how we're doing on that. Let me see if TradingView actually has anything going for initial jobless claims. Well, right now the forecast is for 230, so we're expecting initial jobless claims to be still in the elevated area, right? Again, initial jobless claims could easily crash down to 220, but it's still, telling that we're expecting initial jobless claims to be sticky around this 230 area. As far as next week again is concerned, we do get regional surveys. Some Fed speak. I'm forgetting something that I read before. Well, it probably wasn't that important. But again, regardless, retail sales, that's what I was pointing out. But again, the highlights next week are really these inflation prints. Because again, for now, we have inflation PTSD. It'll be curious to see. Could we see some upside pressure on inflation? It wouldn't surprise me. But I wouldn't also be surprised if we continue to see some further progress on inflation. And again, I'll just leave you with this, and we've really said everything I wanted to say in this video. Last month's print was deflationary. All right, we had the first negative print in quite a while. We had PPI come in deeply in the red. If we have a similar print, that would be two inflation prints that come in not only constructive, they come in deflationary. It is something to consider. Again, even if the bond market decides to look through it, I think that you still it would still be good news for bonds. Again, it would just add to the idea that inflation is kind of a done deal at this point. And what awaits us is, let me rephrase it. Even if what awaits us is a retest and a sweep of this high right here, because the long end of the curve is really a pricing of growth and inflation expectations, if you have deflation, we know where yields will likely head from that point on. So I am sympathetic to the idea that we could see some further softness on yields and some pain ahead for longs right here. And a lot of it will depend on next week's print. If we get hot CPI, that could add fuel to the rocket. If we have a cool CPI, that would just reinforce the idea that perhaps, just perhaps, we don't have to retest this area right here, this $82 mark. But I always leave a window open for that outcome. I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.